A very warm good afternoon to one and all dignitaries present over here. I welcome you all to the HNA National Webinar on discussion on recommendations made in 53rd GST Council meetings. So before we begin with our discussion, first of all, I would like to give a brief introduction to all the speakers who will be presenting the topic. First of all, we have Mr. C.A. Madhukaran Hiregange. He is the founder partner of HNA & Co. LLP, formerly known as Hiregange and Associates LLP, and has 36 plus years of post-qualification experience. He specializes in indirect taxation, and his firm is located at 14 cities in India with 500 plus committed staff. He is also the director of HNA Advisory Services Private Limited. Madhukar sir has jointly authored 36 books in IDT, including GST, and contributed 1,000 plus articles. He also regularly contributes to LinkedIn and Tax Sutra. He contributed to the nation by volunteering as member of Board of Studies, Central Council of ICI for the past 7 years, and especially to students, education and examination. Further, from 2011 onwards, empowered more than 1.5 lakh CAs to take up service tax and then GST practice. He is a co-opted member of the Board of Studies for 2022-23 financial year. In 2024 and 25, he is planning on an online initiative to share what is not taught in schools and colleges in India through the Hiregange Bridge program. He believes in value-based practice and life. Second speaker for the day is Mr. C.A. Sudhir V.S. He is a BCom LLB FCA and is the lead partner at the Hyderabad branch of HNA & Co. LLP. He has qualified as a chartered accountant in the year 2006, and he has done his entrepreneurship development program at the IIM Ahmedabad and LLB at Osmania University. He is an associate member of CP Australia. He has contributed various articles for professional institutes like ICI, ICWAI, and Trade Journal Service Tax Review and Manupatra. He has been a visiting faculty at Voxen Business School, BITS Pilani, and various other esteemed institutes. He has joint authored 3 books on GST for national publications. He was part of the Hyderabad group on GST formulated by ICI and contributed for the preparation and background material on GST for training the CBEC officers. He is a management committee member of FTCCI, past chairman of Indirect Taxes Committee of FTCCI, co-chairman Builder Association of India at national level, member of Grievance Redressal Committee Hyderabad, and a past member of Regional Advisory Committee of Central Excise and Service Department Hyderabad. He is also a special invitee for the years 2023-24 to the Indirect Tax Committee of ICI, New Delhi. Last but not the least, we have Mr. C.A. Ravi Kumar Somani. He is the lead partner for the Pune branch of HNA & Co. LLP. He qualified as a chartered accountant in the year 2012. He practiced exclusively in the area of GST, customs and FTPs. He has performed indirect tax reviews across varied sectors and has guided clients on workable business models, developing systems, and processes for compliances under indirect taxes, including GST. He has given lectures at various professional forums on service tax and GST, written various analytical and issue-based articles on important matters concerning indirect taxes. He has also authored 3 books in indirect taxes, and he, as I told you, he is currently heading the Pune branch of HNA & Co. LLP. He will be joining us in a short while in the program. We shall have a query session in which by our speakers. So I would like to invite the speakers to please carry forward. Thank you.
You are going to put the PPT, Mohammed?
Yes, sir, I will do.
Yeah.
So the screen is visible. Hello.
No, not to me. Yeah,
Ah,
thanks. Thanks, Mohammed Azhar, for a crisp introduction. Today's
welcome, sir.
session, thank you. I will start off with a bird's eye view. You can go to the next slide, please. Okay, you've given me the control, right? Or it's not moving. Azhar, you may have to do it. Yeah, thank you. Uh, Go back. Yeah. Because I don't know what's happening. 'Cause twice it has happened like this. Yeah. Yeah, please keep it here. I have another 2 slides to cover. That's it. I would like to start with, there is a general euphoria. GST was a wonderful law for all the large enterprises, but there were a lot of misgivings if we look at ground realities. Let's look at each of them, the good and the bad. First, GST was supposed to broad-base taxation. That means more and more people were supposed to get into GST, which has been done quite well, I would say. This has been done by eliminating exemptions to some extent. There were some other economic actions which were taken, like the Aadhaar card, the linking of invoices, e-invoices, the GST portal itself not allowing certain things to be done unless you have complied. These were broad-based. This broad-based the taxation in India. This is a good plus. When GST came, along with broad basing, they also said that we will ensure there is no taxation on taxation. On tax. Tax on tax will not be there. The price will not be distorted because of that, which was a problem of the past. If we look in the past and we look now, there was service tax wouldn't be allowed to a trader, and a trader could not take credit of service tax. This was a major issue. Other than that, there were certain items which were outside the VAT regime and have been kept outside the GST regime also. When GST was introduced, they said a couple of years down the line, they are going to bring petrol, diesel, gas, and maybe going forward stamp duty. Unfortunately, now 7 years has gone, but they have been collecting record amounts of tax, and that has ensured that the success has gone to the head of the department of the finance ministry. They have forgotten all their old promises. There were a lot of artificial restrictions, time restrictions, document restrictions, and in GST, you have a state tax and then you also have a central tax. It was all supposed to be seamless. Expenses which are related to business were restricted, like construction, etc. Unfortunately, again, even in GST, these have continued. Maybe about 10% relaxation of the restrictions were done. GST was supposed to bring in an era of simple taxes which people could follow without difficulty. It is fairly complicated. The good thing is, of course, earlier you had 11 complicated laws. Now you have one complicated law. When we see in the GST Council objectives, they are supposed to reform the tax. And that is why they were supposed to meet regularly. Unfortunately, we see almost in every GST Council meeting, they are not biting the bullet. That means the hard job of making the tax law itself simple, they are not doing and tinkering with it. The compliance cost for the taxpayer was supposed to come down because we had 11 taxes, maybe 3 would be applicable, sometimes 4 taxes could be applicable to some of the companies. Now only 1 is applicable. However, GST compliance is very difficult. This is because of too many changes and tinkering. As I mentioned earlier, instead of a fresh draft being taken up, all of you would have, who are under GST, would have received notices. This is without exception. Everybody got notices, and many of them are ridiculous notices. The officers have been given excessive powers, I would say even draconian to some extent. And therefore, they have got quite high-handed in their execution. Many of the officers say, I'm going to raise this notice unless you comply with what I need, his personal needs. Or I will make a demand, then you will have to pre-deposit the tax, and so many crores will get stuck up. I'm not asking much. Give me a part of the interest, you will say, of a action which he is going to take, which is not legal. You have to understand that part. Go to the next one, please. One of the other promises were to make law transparent by using information technology. I would say the quantum of adoption of information technology in GST is enormous. Many of it we don't know also. There is a huge database available on everybody because now everything is linked. Your toll is linked to your invoices. E-way bill is there. And then you have, of course, payments now being done seamlessly, thanks to Nandan Nilekani. The UPI payment gateway has been a revelation for the rest of the world. Many people are trying to copy it, including Japan. The government's objective of reducing collection costs has certainly happened. It is one of the promises which I would say they made to themselves, made their job easier. One thing really makes me, hurt. There's an utter lack of knowledge and skill training for the officers. Before GST came into being, at that time I was the chairman of the indirect tax at ICI. We made a booklet, training booklet, not booklet, actually it was a huge book, background material for training. It was some 600 pages book which we gave to the department, and we also undertook the training for some time. That book was on the table of many people, unfortunately not read, not explained fully, because there was a huge resistance to learning in the departmental officers. We find even the authorities like Commissioner Appeals, advanced ruling authorities, they have not gone through any exam. They have not got evaluated. So what are they going to do? Many of them, sorry to say, are like a razor being given to a monkey, knife being given to a monkey. Not only it is doing great harm to others, it's also harming itself, which means its own collection. The credibility of the GST department is going down because of officers who don't have knowledge and skill. GST Council itself has become a joke. This council meeting took place after 8 months. How are you doing this? You're supposed to meet every 3 months. And you're supposed to have developed the law by now. 7 years has gone by, and they make a big issue about it. If you go through the minutes of the GST Council meeting, this time's 53rd, you will find dozens of items which says deferred. And many issues which are critical and have been litigated for the last 4 years, 5 years, many of them sitting in high courts and Supreme Court, They are not being taken up and saying status quo will be maintained. When GST came, remember, it was also one of the things which helped the present government to get into power. They said we will reward the honest. This has been pure lip service. Every time there is something, it is harming the honest because a few people, maybe 5% of the people evade, and the honest are made to pay the cost of it. Also, the honest should have been exempted from all that. They said we will reduce the litigation. Unfortunately, again, this has not come true in GST. They are using IT. Wherever there's a difference, there's automated notice sent. So there are millions of notices sent for difference between the income tax balance sheet and the GST balance sheet. Any businessman would know what are the differences, but nothing, no application of mind. Simply there is a difference, so pay the tax along with the interest and penalty. All of those cases would come to naught, or I would say 95% would come to naught. Some other issue will be there which may be a cause of non-compliance. Another issue has been that, there is a time limit for making a notice. Now the department has failed to make notices in time. They didn't go through all the returns which have been sent, various reports which are with them, which could have ensured that well in advance demands are made. For example, I made a mistake in the year 2017-18. Today they cannot even recover it. 18-19, there was a little window because of COVID, extension of time was given. But even then, they started issuing notice in the last possible month. And when you do this, what happens? You can't apply your mind. You just want to make the notice and see that later we'll see. So that time bar is saved. These are all not fair to the citizens. Remember, we are a democratic country. We are not, Putin's Russia or Hitler's Germany. The officers are able to get away scot-free. There are no measures to make the officers accountable. This was there about 10 years back in Central Excise and it was removed. There was one provision on vexatious search, but that was removed. So now they can do whatever they want. You can only complain, maybe you'll have to file a FIR. And if you do all that, you may even take on the department as a whole rather than that particular officer. Go to the next one, please. You would have heard so many nice things about the GST Council meeting, but I think this is more of a sham. Spirit of genuine effort to resolve major issues is totally missing. They have, of course, touched here and there. You'll hear about it from Sudhir and Ravi. Some good things also. Movement towards reform is too late already. And what I am seeing here, now the GST Council meeting took place, they issued circulars. Now they will clarify the circulars because the circulars do not take forward the GST law. And all of this will end up in court. Why are they sidestepping the complicated issues? In fact, I would advise, I'm sure there are going to be some officers on this program. I would suggest there is a wonderful book of Brian Tracy called Eat the Frog. That means the problem which has been stopping you for years, face it, eat the frog. Solve the problem of reforms by redrafting this Khichdi law. This band-aid approach is not going to help the SSCs. And let me also say that the collections also will get impacted because of this band-aid approach. Classification was stabilized in the central excise regime. Instead of accepting it, they again tried to tinker with it, brought in VAT principles and tried to cut paste some portions or most portions of the central excise law. But you see how many problems are there. When GST came, they said there'll be a single rate of tax. It was practically impossible, I would say, for a country like ours with such a large divide between the rich and poor, which is increasing year by year. the number of people under poverty line even now is 40%. Maybe 25% don't even eat 2 regular meals a day. And this particular issue is given to a group of ministers. If GST Council, which is full of experts, cannot do it, what are they doing giving it to a group of ministers? What are they going to do? Do the ministers know the GST law? I'm sorry to say, this is a joke. It is a classic example of pushing the issues by a couple of quarters or years, I don't know. Many of the beneficial measures which they had announced when they stood for election 2013, 14 and all that, they announced it, not clearly provided. They just touched on it and left it. There is no mechanism to take the benefit. This, you might feel, is such a critical start to what you read in the papers of various experts saying how great this law is, or how great the GST Council meeting has gone. This is only the other side of it. And I thought that somebody should bell the cat. And therefore, with all humility, I present you this. I am also a patriot of this country and hope that this GST law becomes really simple, fair, and transparent. Thank you very much for your patient listening. I will be joining in the end along with Sudhir and Ravi for the question answers. Over to you, Sudhir. You're muted. You're muted, Sudhir. You're muted still. Mohammed, I think Chetan, probably in the end you can again do this. You have to call Namrata or something? You were able to speak that time.
Now you are able to unmute yourself, sir.
You'll have to unmute and speak. Sudhir. Should I continue?
Namrata, Sudhir sir is getting connected or it is taking time?
Sudhir sir is not able to speak. Okay. Sudhir is rejoining. Sorry, delegates, he'll be rejoining. These technical problems keep coming up in spite of so much of development in IT in India.
Okay. So, in the meantime, I can take who is navigating the PPT?
Mohammed Azhar.
Yes, sir. Just giving you the control.
Can you go to the next slide?
Sir, I am giving you the control.
Can you help me with moving to the next slide?
Okay, one second.
There is some problem in this control giving up. Huh? Even I had the same problem, Ravi. Okay, I'll mute myself. Go ahead, Ravi.
Yeah. So until the time Sudhir sir joins, I will start the discussion, and then as soon as he joins, he can continue the deliberation. So Azhar, you can just let me know as soon as he joins so that we can hand over the reins to him. So as Madhukar sir has started and gave a bit introduction as to at the policy level, what are the things which we still expect as taxpayers, but which is not happening. To some extent, we all say that yes, this particular 53rd GST Council meeting has made a lot of positive changes as well, and this has something to do with have come out. So coming to one of the very important positive change that is brought in this particular amendment is an amnesty for waiver of interest and penalty. Now, let me just share here that this is they are bringing another section, which is section 128A, to conditionally waive the interest and penalty for the demands raised under section 73. Let me tell you that section 73 is in those cases where the demand is raised without the allegation of fraud or collusion or suppression. It's an unfortunate thing that most of the demands have actually been raised under section 74. But in case the demand is raised under section 73, then there is an amnesty that is going to come, wherein assessee is given a choice to make the payment of full taxes before 31st of March 2025. And once this payment is made, there is no question of paying interest and penalty. This particular amnesty is for the demands for the period financial year 17-18, financial year 18-19, and financial year 19-20. The logic or the reason or rationale behind this particular change is very simple, that when GST law came, it was new, and a lot of assessees have made mistakes in the entire implementation mechanism. This is one of the reasons for bringing this amnesty. One important thing is that this amnesty is giving a waiver of full interest and full penalty. Now, this is something important, because generally when the amnesty comes, even in the past, the waiver for penalty, let's say, is 80% or 70%, or interest is 50%. But here it's a full waiver. So as businesses, as taxpayers, we need to relook at all the litigation cases that have undergone in last whatever financial years, 17, 18, 18, 19, and 19, 20, or relook at our books overall for these financial years, and see that if there is anything that is disputed, and we feel that it's better to pay off and avoid litigating this particular aspect, then one can look at taking the benefit of this particular amnesty, which is a welcome move. Of course, one would always say that this type of amnesties actually are against the compliant taxpayers, because a compliant taxpayer has ended up paying tax along with interest or penalty and timely paid the tax. So time and again, when the amnesty comes, it actually depletes the trust of the compliant taxpayers. Very important. Yeah. Okay. So I think Sudhir sir has joined. So sir, I've just
I'm audible now, Ravi.
Yes, you are audible. Absolutely. So I've just given.
Thank you. My apologies for everybody for this technical glitch. Thank you, Ravi, for filling in the gap. I think you have covered about this amnesty. So I'll just give a quick
I have not covered amnesty in detail, sir. You can continue.
I'll do it.
I'll just give a brief
so most of the people would be aware that you have been given a tons of notices on reconciliation and small errors which has been there. In the initial days of introduction of GST, there were a lot of errors which has been committed knowingly or unknowingly. And many of the things are also a procedural error, and sometimes it is actually having a small implication of payment of tax. So there was a representation which was been made for giving a waiver for the initial period where the tax amount has been not paid because of some challenges. there should be a waiver which is to be given and sort of an amnesty. So now there is a 53rd Council has recommended formulating a new section for this 128A, which is going to be inserted in the upcoming budget, where they are saying that for the period 17-18, 18-19 and 19-20, 3 financial years, all the notices and the orders which are issued under section 73, you would be given a waiver of interest and penalty, subject to you make the payment of the tax which is demanded under section 73, proposed to be demanded or demanded as the case may be. Another condition which also is been looking at here is that they may also be requiring us to pay all the tax dues proposed in the notice rather than one among the tax dues. So what is that? Say for example, when they came for an audit, they made 4 para objection, out of which 1 was payable, 3 is contestable or vice versa. And you opted to pay 1 and contest the 3, but notice was given 1 and you are fighting out the notice. Now 168 will not permit you to close that 1 para by paying that amount along with paying that amount within the due date of 31st of March 2025. It will not do. You also have to sacrifice the other 3 points which you are fighting, and thereby that entire notice or the order, as the case may be, they want to close it. So in some cases this scheme may not be practicable, and some cases it could be practicable. But you have to look at and make a cost benefit analysis. In many cases, we are fighting a very small issue. We don't know where the conclusion is there. But when we are fighting it, we are more bothered on paying on interest and penalty, because 17-18 interest is coming itself more than 100%. 18% per annum, if you look at for 7-8 years, it's coming more than 100%. So it is another penalty of 10%. So it is becoming a big burden, and people are taking a stand to litigate it. So government wants to eliminate only these things where the people are disputing only because the interest burden is high or the penalty burden is high. Only for them to give a benefit, they are coming up with this particular scheme. It may or may not be attractive. In most of the cases where the demands were payable, I understand 60 to 80% of the assessees, at least our clients, where it was payable, they have paid and taken a benefit under another scheme which the law provided, that is section 73 subsection 5, where the entire amount of interest, entire amount of demand along with the interest, it prior to issuing of the show cause notice, if you have paid, then the penalty waiver would be there. So most of the cases people have taken that benefit. So once the people have taken that benefit, there is no question of show cause notice and no question of this waiver of interest and penalty. The people who have taken the show cause notice have taken only because they have some ground to fight it. So thereby, I don't see this is going to be a huge sort of a benefit, which is going to be roads are going to be flooded and somebody is going to take it from here. So we have to carefully watch how it is going to happen. Of course, we also have to see the fine prints, how it is going to happen. So can I go for the next slide, please? Okay. So there are a few things which is clear is that the erroneous refund, if it has been done, they are not going to clear that interest and penalty waiver will not be given. So those things they have made it clear. But one of the things which there has been kept open is that most of you would be aware there are 2 sections to propose the demand. One is section 73, which is a simple case, and section 74, which is a fraud case. Now there is another section which I'm going to discuss, which they want to introduce, where they want to bring the third mechanism and remove out all these fraud and non-fraud cases. Having coming to it, till now, if you look at 74 and 73, a notice which is given under 74 alleging the fraud, collusion, misrepresentation. Once you prove that there was no fraud, collusion, misrepresentation, things like that, it can always be converted into 73 notice. Now the issue comes is that a show cause notice or the order has been passed within the period of section 73 itself, but the notice was given under 74. Now you are under the appeal, and the appellate authority says that yes, I agree with you that the notice should not have been given under 74. I am going to convert it under section 73. Whether I will be eligible for getting the waiver under this proposed section is what 128A is what we need to wait for it. Now, don't get confused that if there is any notice which has been given now, it will be given under 74, and if has to be converted under 73, it is time barred for these 3 financial years which we are talking about. So thereby, this will be only for a notice already issued now under 74. We get it under 73. That also this scheme should be giving us the benefit. So matters which has already been there under the appeal writ petition, we are also looking at whether we need to withdraw the appeal and apply for the scheme and settle, or the appellate commissioner himself or the writ jurisdiction itself will settle under section 128A, because a new section has been there. Without having the rules and procedures for this, we are not very sure about it. We need to wait and watch. Case where the appellate authority has decided the matter, possibility of waiver in total portion of the demand upheld by the appellate authority. So this is the other thing where we need to wait how the appellate authorities which has been upheld, whether that also can be get settled is something which we need to wait for. Yeah, next slide. This is a very interesting proposal which has been coming, is the interest balance in electronic cash ledger. Most of you would be aware, in many cases, there was a delay in filing the returns because of some technical challenges was been there. So initially the challenge came is that I have to make a payment of 1 crore rupees output tax, and that is been paid by 80 lakh rupees debiting the input tax credit and 20 lakhs in the cash ledger. The question came up is whether the interest has to be paid on 1 crore or on 20 lakhs or on 80 lakhs. So initially the view was it should be on the entire 1 crore. There was a round of litigation, round of amendments, 2 rounds of amendment to section 15. And finally, with the retrospective effect, they told that, see, there is no revenue loss to the government because 80 rupees was already paid by my vendor. What I did not pay is only the 20 lakhs in this example, and thereby the interest should be liable only on 20 lakhs when there is a delay in filing of the returns. No, point well taken. There were certain people who also deposited 20 lakhs in the electronic cash ledger as on that day, but for some reason 3-4 days they were not able to file the returns. Once the money is deposited into the electronic cash ledger, it is already gone to the treasurer kitty. Now, the same logic that there is no loss on this 20 lakhs also, then why are you collecting the interest? So now this current provision is saying that if you had a sufficient balance in your electronic cash ledger to fulfill that liability, even there is a delay in filing of the returns, you will be not liable to pay the interest. This is coming more from the Madras High Court decision in case of Eicher Motors, where they told that the interest is applicable only when there is a loss to the government and not in this case. So whether the similar relief we were going to get when there is a default in the payment of GST, where the GST 3B was filed. So this is the second scenario. My idea is not clear. Okay, is it better now? Okay.
Your audio is proper, Sudhir. I think it could be a problem with the user.
Okay. So now as far as this scenario is concerned, one is 3B delay filing. Consider 3B is filed on time. There is one particular liability, one invoice I did not disclose and paid it in 3B. But my electronic cash ledger to the extent of that invoice was already available. Now this was disclosed in subsequent 3Bs or paid through BRC or paid during the audit. Can I still argue saying that the interest should not be applicable under this new proposal? It is a bit doubtful, which requires a clarity. But in the ratio of the decision of Eicher Motors Limited, because there is no revenue loss for the government, still that argument should be taken is that to this extent the amount was very much available with the department, and thereby the interest and penalty should not be there, is something which can be looked at. And also the clarity where if you already paid the interest because there was a delay in payment, whether I'm going to get back the refund of the interest which has been paid is also something we need to wait and watch. Generally in amnesty, like the other amnesty 128A we talked about, where they have made it very clear that the taxes which has been paid hitherto will not be given back, because we are settling this under this particular section. But here there is a proposal to amend the way the interest should be levied. So interest, if it is already paid, there may be a chance that getting the interest back also could be possible. We need to wait for the fine prints. Next slide. Now section 74A is the new section which they are proposing to give for prospectively from 23-24 financial year onwards. So as I told, there are two sections presently, 73-74. 73 simple cases, non-fraud cases. An order can be passed within 3 years from the due date of filing your annual returns, and notice has to be given 3 months before that. In case of fraud, collusion, misrepresentation, and so on. So the order can be passed for 5 years from the due date of filing your annual returns, and the notice for that has to be given 6 months prior to the order date. So thereby, these are the two things which is going to be there. Department generally is making its efforts to give the notice within the 73 window. By chance it is not happening, default they are giving under 74. Or to connect the penalty, mandatory penalty, they may also be giving within the 73 windows. So now many cases, the data is almost very much available with the department. The returns have detailedly filed. So the cases of section 74 is very, very less. 74 will be only in cases of those investigation cases where some goods have been caught without the invoices during the transit. Only in those cases 74 will be strong, but a routine notices 74 may not be strong at all. And the time burden of 3 years is also not sufficient for the department, surprisingly. So if you look at VAT and central excise service tax has come together, and there is a duplication of manpower now, despite of so many people in the system, they are expressing their inability to give an order, give a show cause notice and pass an order within 3 years. So considering their request, they are proposing a new section which is called as 74A, where they are saying now onwards, financial year 23-24 onwards, I am not going to differentiate fraud and non-fraud cases. The notices will be given under section 74A within that time limit and that specified period. So we are expecting that it could be somewhere about 42 months instead of this 36 months, 3 years, 12 into 36, that may be increased to 42 months. And the demand notice can be issued 12 months prior to that particular period. And they'll also give extra time. You have to settle the notice for a waiver of penalty in case of non-fraud collusion cases. That is presently 30 days under 73(5). A similar thing they may extend it to 60 days. So this is what the proposal is all about. So for the notices for the financial year up to 22-23, so either 73-74 still will continue. But for the financial year 23-24 onwards, a notice can be only given under 74, subject to the section 74 get passed through the parliament and gets the president assent. Next. Now there is another circular for reducing the government litigation. Sometime back, about 5, 6, 7 years back itself in central excise, they identified this particular problem. What was this problem? Was that today, if you have agreed by an order, that order has not come in your favor, if you want to go for an appeal, there is a cost for going for the appeal. Either you engage a consultant or your in-house team has to put sufficient time and efforts to go for an appeal. There is an additional cost for going for an appeal. So you are now making a cost benefit analysis. Alright, this demand is about 1.5 lakh and I have to engage an ex-consultant. He may take certain fees and there is going and coming to tribunal 5-6 times. There is a loss of productive time. There is a cost of going and traveling of consultant. That may not be worth for me to litigate and you are not doing it. But when it came to the department, that is, the order is in your favor, but against the revenue doesn't have additional cost at all. Their existing employees are there. They will only file the appeal. There are empaneled counsels, no extra cost, nothing, zero cost for them to go for an appeal. And thereby, on a routine basis, earlier in central excise, we have seen almost on routine basis, every order which has been passed was been gone for an appeal. So we were telling it on a very lighter note, saying that the exit is at the inspector level where he doesn't make a show cause notice, or the moment he makes the show cause notice, the exit is only in Supreme Court. Because even if you win, they'll keep on going for appeal because there is no cost of going for the appeal. This problem was identified, well identified, and it was arrested by putting the limits for department to go for an appeal, where they had told tribunal, if you want to go for an appeal, you can go for an appeal only when it is 50 lakh rupees, High Court 1 crore, Supreme Court 2 crores. The same thing has been bought under GST also now. Up to tribunal, there are no limit you can go, but beyond up for the tribunal, you want to go for an appeal, 20 lakhs should be the minimum demand, including of CGST plus SGST. If only penalty is being demanded, the penalty should be 20 lakhs. If only interest is demanded, interest should be 20 lakhs. But where demand of tax, interest, penalty is there, only tax demand will be taken. Interest and penalty is there, interest and penalty will be taken. If it is only penalty, penalty will be taken. That should be 20 lakh rupees. Then only the department can, if it is less than 20 lakhs, they cannot go for the appeal. If it is beyond 20 lakhs, they can go for tribunal appeal, 1 and 2 crores accordingly. So this is in way it's a welcome move. Otherwise, there was no end for litigation, and we had to keep on fighting for it. So this is something which is a welcome move, which has been there. Maybe the limits could have been better. It could have been the previous limits for tribunal 50 lakhs could have been better. Maybe they will increase it over a period, is what we need to wait and watch. They have given certain exceptions for this. The exceptions for this is that where there is a challenge of the wires of a circular or a wires of the rule with the section or a section with the constitution, any wires which has been challenged, they can go for an appeal. If the issue is of classification, valuation, they can go for an appeal. So like that, certain, without the monetary limit, they can go for an appeal. There is a certain exception which has been carved out, and they've also made it ample clear. Only because an appeal is not preferred because of the monetary limit, that ratio will not become final. That whatever they have held, say RCM is not applicable on corporate guarantee, say for example, they say. So if corporate guarantee tax is not applicable, they told, it is not final because I have not gone for an appeal. It is still contestable in other matter. So that they have made it very clear. Next. Filing of appeal before the GST tribunal. Most of you would be aware that GST tribunal is yet to be formed. All the orders which has been passed by the commissioners or the joint commissioners, and where the you need to file it within 3 months, and further extension about another 3 months. Now what they have looked at is because the tribunal was not formed, order has been passed, 3 months is getting expired. So they gave a removal of difficulty order where they say it is from 3 months from the date of communication of the order or date on which the president assumes his office. So Sanjay Kumar Mishra, the retired Honorable Justice, as appointed as a president, and he has assumed the office in the month of May 2024. So technically, as per the previous amendment or the removal of difficulty order, the time limit has already started triggering. Now they are proposing, saying that it is not only the state, the president which has been formed, we will notify from when it is going to start, from the date of the notification or the date of commencement of the communication of the order, whichever is later will be the due date for you to file for the tribunal. So however, it is been suggested that wherever you have a case where you need to go for a tribunal, irrespective of that, it is a professional approach to keep the appeal draft ready and only wait for those forms and procedures to upload it, because when things are fresh, it becomes lesser efforts for you to prepare an appeal. Otherwise, next 1 year or something, you will totally forget about the case and you have to invest more time than what is required. Next. This is another welcome move, I can say, where the pre-deposit was deterrent for people to dispute. Even at the reduced level now also, I feel it's a deterrent. Historically, under service tax or the central excise, there was no pre-deposit. You can file an appeal without making any pre-deposit. However, an application of state case, and if you are established that you have a very good case prima facie, they used to give you a 100% waiver of pre-deposit, and thereby anything which you have agreed by the law, you had an incentive to dispute. Now what they did under the GST regime, they told that if you want to go for first appeal, you have to pay 10%. And if you want to go for the tribunal, that is the second appeal, you have to pay another 20%. So 30% of your money is getting blocked mandatorily. Balance you need not pay, it is automatic stay. So now people will be thinking that, like Madhukar sir was telling, that either you reconcile with me or actually your demand is only in few lakhs, but I will ensure that I am going to make it few crores. So I will just give you a demand of 5 crores, which is not payable at all, but I'm going to give it. Now, what is that which is going to happen? 5 crores into 30%. About 1.5 crores or so, you have to deposit and keep for waiting for your turn to tribunal to dispose it. And after it is disposed, again follow up and get the money back. All these things may take few years. And even if you take a simple interest of 8% or 9% for these years, that amount itself is huge. So this is something trade was being represented. They have considered partly, and instead of 20% in the tribunal level, they have reduced it to 10%. That is a small relief which has been given. Next. There were few other clarifications which has been given. One is that when the pre-deposit has been made, they can make the payment of pre-deposit through DRC 03. Generally, what used to happen is that the department used to insist for making the payment before issuing the notice. The amounts are paid in DRC 03. It has been appropriated in the order. Again in the portal, and that was leading to filing of manual appeal and all the challenges. So now the clarification is there that amount paid in DRC will also be considered towards the pre-deposit, which is welcome. Another good clarification which has come in, it is not about good, but it is at least resting the dispute with the department, is the credit note issue. So most of you would be aware that when a discount has been offered, I am a supplier of the goods, 100 rupees plus 18 rupees GST has been paid. Now I am offering 10% discount, that is 10 rupees plus 1 rupee 80 paisa. The law allows me to take the deduction of 1 rupee 80 paisa from the earlier paid 18 rupees, or 1 rupee 80 paisa from the liability to paid in this particular month. I can take 1 rupee 80 paisa deduction. That is, I'll take back the money in whatever form. This was possible with the condition that your recipient should reverse the input tax credit of 1 rupee 80 paisa, which is very, very logical. Earlier I told 18 rupees is the credit, I paid government 18 rupees, my customer took 18 rupees input tax credit. Now I am saying that 1 rupee 80 paisa is not yours, you give me back. My customer still enjoys 18 rupees credit, then the government is losing. So they have put an onus on me that, boss, it is your duty to ensure that your customer is reversing when you are taking this money back to me. Logic is good. Government should not lose, but you tell me, how will I ensure, how will I prove my customer has reversed the credit or not? So this was not possible. And departments in all the audits and the ASMT scrutinies and all, the credit note discount, they were making an issue. Now the circular 212 has come in, where they have made it clear that like 198 circular for this ITC, they told you take a declaration from your customer. If it is less than 5 lakh rupees that he has reversed the credit, I will take it on that. If it is more than 5 lakhs, you take it from his chartered accountant. And just don't take a one-liner certificate. A chartered accountant should clearly mention all the points that these are the credit notes, these are the reference in which the reversal was made through DRC or GST or 1 returns, or 3B returns, whatever is there. You make that entire summary, take a certificate from your chartered accountant, from your customer's chartered accountant, then the reversal will be permitted. So this is a good move which is been given. Next slide. So I think this is where I had planned for my coverage. Here onwards, Ravi is going to take care. I will again join in few minutes for the question answers. I may be logging out for a small while, but I'll again log in back for the question answers. Ravi, over to you.
Yes. Thank you very much, Sudhir sir. So I hope I am properly audible. I will continue with the deliberation. So as you can see, one of the another very important amendments, or I would say something for which the industry was waiting for long, was this input tax credit denial because of the 16.4 time limit. So basically, as we all know, that for each financial year, there is a time limit to take the credit by the return of the September of the next financial year, which was extended to November 30th of the next financial year in the last amendment. So it so happened that in initial period, that is financial year 17, 18, 18, 19, 19, 20, businesses have delayed due to various reasons. They could not file their return on time, which is a March return or February return. And that could also be because currently the return is to be filed along with making the payment of taxes. And if you don't have funds, you are left with no choice but to not file the return. And there were many writs filed in the various courts as challenging the wires of constitutionality of section 16, subsection 4 time limit to take the credit. Almost all the judgments have come in the favor of the department, saying that the time limit under section 16.4 for taking credit is constitutional, it is legal, except for there was some contrary high court rulings. So there was no choice for the taxpayers but to lose the credit, which was a big amount for each taxpayer. So with this particular amendment, or I would say amnesty, what they have told is that for financial year 17-18, 18-19, 19-20, and 20-21, for these 4 financial years, an assessee, if he has filed his return or taken the credit in the return by 30th November 2021, it is as good as credit taken within the time limit. So indirectly, I can say that the time limit to take the input tax credit for financial year 17-18 to 2021 is November 30th, 2021. Now, there is an interpretational issue. There is one interpretation coming as to this November 2021 has to be looked at for each year onwards, or is to be looked at for all 4 years put together over there. For example, for financial year 17-18, at the most it could be November of the next financial year. Similarly for 18-19. So we need to wait for the actual text to really see how this is there. But I believe the interpretation 2, which would be the right, wherein any financial year, anywhere you file, no matter what, but the ultimate deadline is 30th November 2021. So it's a welcome amendment, I would say. Of course, for whatever the delayed file returns, the interest and late fee or whatever penalties are there, that would be required to be paid. Can we go to the next slide? Some things, one another amendment in the same context is that if, let us say, the registration was cancelled or suspended and later it is revoked, in that situation, the credit can be taken within 30 days of the revocation order. And probably the text of the law would be November of the next financial year, November 30, or 30 days from the date of revocation, whichever is later. So this would also resolve all the disputes where businesses were not able to watch once the actual text of the provision comes in. Can we go to the next slide? In case a taxpayer has already reversed the credit, already he has taken the hit of the taxes, or already he has paid the taxes with interest and penalties, in that situation, one can look at as an option of applying for refund, because this particular matter is not covered under 11A. So one can look at option of actually applying for refund or looking at a mechanism to claim back the credit if that particular reversal is already been made. If a particular taxpayer has chose to file an appeal, or the matter is currently pending before any of the adjudicating authority or appellate authority, or has filed a writ petition, for litigation and availing the benefit under this particular thing. Very important, let us say currently the credit taking is linked with GSTR 2B, which means that if the supplier has not uploaded the details on time, and assessee's credit is denied. So this is one area which they have still not given any clarification on, because currently a person's credit taking is not dependent on himself, it is dependent on suppliers return filing. So a linkage over there, and that could be a reason for delay in taking the credit, is something which has not been clarified as of now. But all in all, this is a real welcome move, and it will definitely benefit a lot of MSME taxpayers. So in case any of the businesses where the money has been held because of the delay by the customer, one can look at taking the benefit and taking back the money from the customer if the money has been debited by the customer on this account. So these are the things one can look at for this 16(4) time limit. Next slide. Next, very, very important amendment is in the context of valuation for supply of import of service by the related person. So what has happened is that we all have seen that there was circular 199 that has come in the past, wherein it was mentioned that in case of transaction between distinct persons, if there is full input tax credit is available, then even a nil value invoice will be deemed to be an open market value, and whatever is billed on the invoice will be deemed to be open market value as long as the recipient is able to take the full input tax credit. So this particular clarification under what they have done now is they have extended this particular clarification in the context of foreign party transactions as well. So many times, and especially in the past, there has been a lot of litigation where the foreign party has not charged any consideration to the Indian party for various benefits or services provided. For example, many times foreign company may give the IP or patents, trademarks, or various other support, and they don't charge to the Indian recipient with a clause that for initial 3 years or initial 5 years or till the time there are losses, there will not be any charge, and the charge is made later on. So wherever there is no consideration, department, by taking the cover of Schedule 1 and 2, they were demanding this to be a deemed liability, and they were demanding taxes and interest and penalties for the earlier financial years. So this particular amendment, clarification gives a clear clarity that in cases where the foreign party has provided any service to the Indian party, where there is no consideration charged, it means since they both are related persons, it would mean that the value is nil. And if the recipient is eligible for full input tax credit, there should not be any demand in these cases. This is also very clearly coming out in Rule 28 of the CGST rules. So in a way, one can say that this clarification is nothing new. It is actually what the rule says is what is being clarified. So next slide. Very important. There has been a lot of interpretational questions that have come in this context. Someone has raised a question as to whether this particular benefit or a clarification would make all the RCM provisions redundant, which means that nobody would like to pay taxes under RCM on the point that recipient is able to take the full input tax credit, and why to pay tax under RCM. Let me tell you, this particular view will not hold good for two reasons. One is that in this particular clarification, it is very clear that this particular circular is only in those cases where there is no consideration charge. In fact, that comes in the opening para of the circular. Second important thing is that when we look at Rule 28, this particular nil value acceptance is only in case where somebody raises a nil invoice. But if somebody has raised an invoice of a particular value, if the foreign party has raised an invoice of a particular value, then that value will be deemed to be the open market value. And one cannot say that despite the bill being raised from the foreign company, I will not pay tax under RCM because I am anyway eligible for the full input tax credit and the entire thing is revenue neutral, would be an aggressive stand and may not be acceptable. Forget about clarification. It is not in line with Rule 28 of the CGST rules. Now there is another question that is coming. Can this benefit of clarification be also extendable to the domestic related party transactions? Extremely important, because earlier circular talks about the transaction between distinct persons, not between the related persons. Let me tell you, related persons are different from distinct persons. There may be a company, a group of company with many holding subsidiary or sister companies in the group, and the transaction between the related persons is also governed by the same mechanism. So there is a view that is, or there is a point coming is that when you are giving this benefit for the cross-border transactions, why not for the domestic transactions? This is against Article 14, right to equality or whatever. Let me tell you is that the same benefit can also be taken for the related party transactions as well, because as long as the recipient is able to take the full input tax credit. But very important again is that if the consideration is charged, then that consideration has to be considered as per Rule 28. Only in cases where no consideration is charged, one can look at taking the benefit of this nil value, which in fact, this can be a good mechanism to plan the taxes. Many times we see that in a business with multiple registrations or with multiple group companies, there is an accumulation of input tax credit in one of the numbers, and in another numbers they are paying in cash. So by virtue of this circular, now department itself is clarifying this. One can look at planning their taxes because the valuation flexibility is now, it was always available, but now it is also very clearly clarified by the department. So if for the past, let us say somebody has wrongly charged excess and there is an accumulation happening, one can also look at passing a credit note and closing that accumulation, because many businesses we see accumulation of credit leading to working capital blockage. Next, very important point we need to also understand is that this particular thing cannot be done as a matter of routine. I cannot say that I am transferring goods from Maharashtra to Haryana. The value of the goods is 1 lakh. Let me declare the nil value and remove it in the nil, because anyway I am eligible for full input tax credit. it is revenue neutral and there is no liability. Let me tell you, there is an impact. Because if you under declare the value, or if you short declare, or you declare the value as nil, then the recipient location, if the goods are sitting over there and it is not sold or delayed sold, then the recipient location is not getting the revenue to that extent. Of course, it's a value-added tax. In case of B2B, one can say that there is no impact even to the recipient location. But then, no goods, once they are removed, are immediately sold, or no services are immediately sold. There's always a time gap. So if this particular practice is taken as a matter of routine, then let me tell you, it would defeat the purpose of GST, and the taxes would be sitting more in the manufacturing locations and not in the consumption locations. Very, very important is that, what do you mean by the recipient should be eligible for full input tax credit? Does the term full input tax credit has to be looked at qua the invoice or that particular transaction, or qua the GST-IN? In our opinion, that particular thing has to be looked at qua the transaction and not qua the entire GST-IN. So only for that particular invoice, it has to be looked at. Next slide. Then this is another very, very important clarification, I would say. So this was always a matter of question as to what is the time limit to take input tax credit in cases where the tax is paid under reverse charge mechanism. So we need to understand that the time limit to take credit is given under section 16, subsection 4, wherein the time limit is linked with the invoice. It says invoice or chalan. So invoice or debit note. So very important point is that the invoice, in case where the supplier is registered in GST, there is no problem because he will charge tax on the invoice. In case where the supplier is not registered under GST, the recipient would have to pay GST under RCM in scenario where the specific category of services are liable under reverse charge mechanism. So when the supplier is unregistered, the mechanism given under section 31 subsection 3 is to raise a self invoice. Now this self invoice is required to be raised at the time of provision of service. In fact, they are making an amendment in section 13 wherein there will be time limit for raising the self invoice as well, which is currently not coming out in section 13 of the CGST Act. Now, the time limit, what they have clarified to take the input tax credit is from the time when the self invoice is generated. So let us say for financial year 17-18, I have paid tax under RCM in financial year 23-24, and I have generated the self invoice also now in financial year 23-24, which means that assessee can now take the generate the self invoice, and the time limit will start from financial year 23-24 and not for financial year from financial year 27-28, 17-18. Sorry, this was the view we were carrying right from the time GST law was implemented. We have seen many businesses taking an ultra conservative stand on this and actually not claiming the benefit of RCM. Very important to note that this particular benefit is available only in case where the supplier is unregistered. If the supplier is registered, let us say transporter or security service provider is registered under GST, then this benefit would not be available because he's already raising the invoice. So this is, of course, the point is that when you are paying the tax delayed, interest anyway would be applicable. One cannot say that interest is not applicable. Another very important aspect is that, let us say if the tax under RCM is paid through DRC 03 by virtue of any audit, investigation or assessment, even in those cases, the credit can be taken. In fact, even if the tax demand is raised under section 74, the credit of this RCM can also be taken once the tax is paid using DRC 03. Next slide. This is one of regularize it, and that assessee is not required to pay the taxes wherever this regularization has taken place. A very good example when these recommendations were coming was in the context of gaming industry, where they have raised, demands in some thousands of crores. Many were saying that, they will get the benefit. Of course, that was not given, but this is the enabling section. Till now, they were not having enabling section. Now they have brought an enabling section in place, which means, let us say you were genuinely liable to pay the tax for the past. Legally, when you read the law, when you read the provisions, the rules, you are liable to pay tax. There is no escape. Now, what do? They have brought section 11A stating that even though legally you are liable, but as an industry, as a group, as a particular common trade practice, everybody has not paid tax on that particular aspect, then we will give this benefit. I have seen many automobile part component manufacturing companies where there was a dispute on the taxability of 18% or 28%, where genuinely, even the cases where it is liable to 28%, businesses have wrongly missed and paid 18%. And now the demand of 10% on the gross is huge. One can now look at taking the benefit under this particular provision. So representation has to be filed. This is not a general benefit. Case to case basis, transaction level, government will give this particular benefit. So in the past also, government used to give this benefit, but there was no provision in the act. Now they have legalized this. So maybe they wanted to give this benefit to some big industry player, and they did not have any legal mechanism. And based on the recommendations from law committee, they brought this particular provision. We need to wait and watch. What do we mean by general trade practice? What do we mean by common trade practice? Whether the benefit is only for leviability or it would also extend to ITC classification, place of supply issues as well, is something needs to be, we need to wait and watch. Very important is that if an assessee for whom this benefit has come has already paid the taxes along with interest and penalties, or the taxes are paid, one can look at claiming the refund. It is very unfortunate that in section 11A, they have told that a person who has already paid, there is no question of refund. Agar aapne bhar diya, then there is no refund. But if you have not paid, then you can take the benefit. So in our opinion, as per Article 265, no tax can be collected without the authority of law. So one should look at filing a writ in such cases and claiming the refund as long as there is no unjust enrichment. Another important point is that, let us say if a particular taxpayer has disputed this issue and has not paid, and the matter is currently pending before adjudicating authority or appellate authorities, then one can withdraw the case, and the pre-deposit that is made, the pre-deposit also should be eligible for refund, and that restriction under 11A of refund should not be restricted for the pre-deposit. Extremely important point. Next slide. This is another peculiar issue, I would say. Many businesses, it so happens that there is a corporate guarantee which is being given by the holding company to the subsidiary company, or by one company to the another company. So in the cases of this corporate guarantee, department has been raising a lot of legalize this, saying that the valuation will be considered as 1% of the guarantee amount, and accordingly it was taxed. So till financial year, till October 2023, one can say that it is not liable because there was no rules, there was no valuation mechanism. There is a judgment of Delhi High Court in the case of Suresh Kumar Bansal. It says that if there is no valuation, there cannot be a taxability. So post October 2023, where they have brought in this rule, they have mentioned that the valuation will be 1% of the guarantee amount. Now what they are saying is that even the post amendment, this particular benefit, this particular liability would not come as long as the recipient is eligible for full ITC. Now, what do you mean by recipient eligible for full ITC? I've already, explained. Very important is that department is also demanding for financial year 17, 18, 18, 19, 19, 20, which in our view is definitely not liable because there was no rule making mechanism. Very important also is that when one calculates this 1%, this 1% has to be calculated on the total guarantee amount. Sometimes it so happens that there are multiple guarantors. So if there is multiple guarantors, let us say the total guarantee is 1 crore and given by 2 guarantors. So whether each guarantor has to be paid only on the extent of what they are guaranteeing or on the total guarantee amount which the bank has got. So there also department is levying on the full for all the guarantors. Also, department is levying this particular tax on a year-on-year basis because under income tax under self-harbor scheme, safe harbors rules, the income tax is levied on a year-on-year basis. So they are levying this GST also on a year-on-year basis. In our opinion, is not a right thing because the transaction happens only once and it's a transaction-based tax, should not be levied every year. So what do you mean by the recipient eligible for full input tax credit is something I've already covered in the earlier slide. So this is on the corporate guarantee. Next slide. Yeah. Now, next issue is in the context of ESOPs. So many times it happens that one company gives the ESOPs not just to their own employees, to even the employees of subsidiary companies or the holding companies. So there was an issue in the context of cross-border ESOP transactions, where let us say the holding company has given the ESOP, holding company outside India has given the ESOPs to the employees of the subsidiary company in India. Then department was demanding GST liability under RCM on such transaction. So it is rightly clarified that it is not liable to tax under RCM because first of all, securities are not liable to tax under GST. They are neither a supply of goods nor a supply of services. One can always raise a question that securities of the foreign country may not get covered under the meaning of the Securities Control Regulation Act. We need to really go into the definition, look into the detailing of that. But even if this contention is not accepted, it is also to be noted that ESOP given to an employee is a part of the compensation package covered under Schedule 3 of the CGST Act. Department was raising this demand on the point that the employee is not the employee of the holding company, they are the employee of the subsidiary company. Hence, the benefit of Schedule 3 is not available. So, but very important to also note that in these cases, while the GST is not applicable, even input tax credit reversal also would not come into play because ITC reversal is in a scenario where there are transaction in securities. Issuance of securities by way of IPO, ESOPs, QIPs is different from trading of securities. So ITC reversal is applicable in case of trading or transaction in securities, not on issuance of securities. This is an extremely important difference that one should note. Of course, if there are any facilitation charges or any administrative fees collected as a part of doing all these things, then that would be liable to tax under reverse charge or forward charge. Next slide. Next, another very important thing is an introduction of GSTR 1A. So basically, GSTR wrongly filed or there are some errors that can be corrected before the filing of GSTR 3B. Let me also tell you that the changes made would immediately get reflected in GSTR 2A, but it would not immediately get reflected in GSTR 2B because 2B gets locked and it would be reflected in the next period of GSTR 2B. Correct? So very important question that comes, what is the legal standing of GSTR 1A? Because currently we don't see anything like that in the law. Nowadays we see a situation where first we get a view from the GST network and than from the law. But in the law, nothing is there about GSTR 1A. It talks about GSTR 1. We need to say whether there's a separate form, what will the mechanism, when will the invoices get reported in GSTR 1A, when it would reflect in GSTR 2B, will reflection fulfill the requirement of section 16(2)AA for taking the credit is also something to be looked at. And very importantly, this DRC 01B notices that they are issuing, will this change be considered in the amount reflected while issuing these notices under GSTR 1B? So whether can all documents reported in GSTR 1B amended in GSTR 1A is something once the detailing comes is we need to wait and watch. But what was the reason why this change is made is once a GSTR 1 is filed, there was no mechanism for them to amend unless go to the next month. So this is given so that in the same month itself one can amend and immediately make the correction in the compliance. Next slide. Then there are other important clarifications that have come. One is, if there is a transaction of loan between the overseas affiliated to the related Indian affiliate, it would not be liable to GST under RC. Bill of export, and I've supplied, and shipping bill is done. But later I have raised a debit note. So the current issue that was there is that there was no mechanism to claim the refund in the case of debit notes. So the current GST portal was not allowing this. So what government is saying is that they are going to make a specific functionality through which one can claim the refund even in cases where the debit note is raised for an earlier export transaction. And till the time this functionality is made, one can make a manual application under the others category. Only thing is that once a refund is claimed under the others category, department is not giving the refund in cash. They are giving only by way of electronic credit ledger. There is an inherent limitation in their system, which is something an issue right now. Very important aspect is that, let us say my original export was under with payment. So can I go for debit note under without payment under LUT, or I have to go only for the whatever was originally agreed is something still not clear here. Another very important aspect is that in the case of domestic transactions, there can be a very big issue of interest applicability on the debit notes. For example, let us say the invoice is raised for sale made in July 2024 of, let us say, 100 rupees, for which because of price revision, price increment or change in the pricing, or the escalation clause in the contract, the debit note is raised, let us say, in February 2025. The question that comes is, on this debit note that is raised in February 2025, whether we need to pay interest from July to February period. There is a judgment of Supreme Court in the case of Steel Authority of India Limited saying that interest is applicable. Now let me tell you, this is a judgment issued by Supreme Court under the Central Excise Law. So this is very dangerous in all the cases of manufacturing sector, because in manufacturing industry we see that price difference debit note is very common. Currently, many businesses have not created provision for this interest. It would be interesting to see how we can differentiate the taxability under central excise from the taxability under GST, because under both excise as well as in GST, in case of goods, the taxability is based on removal, which is same in both the cases. However, it is to be noted that in excise, it was purely on removal. In GST, it is supply. Removal plus there should be a supply. So when there is no supply to the extent of debit note, when there is no clarity of supply to the extent in the case of debit note, how can there be an interest implication is something we need to differentiate. Otherwise, if confirmed, this can be a very big issue in GST. a legal issue. Next very important aspect is an amendment in section 16 of IGST Act and 54 to curtail refund of IGST in cases where export duty is payable. What department is saying? Export duty is generally levied when there is shortage of goods or government wants to control export because of various other global market situations. So if the export is controlled, there is no point in giving refund in such cases and trying to promote the export of those products. So products where export duty is applicable, there is no question of even claiming refund on such export of such products. Next important amendment is in the context of suppliers who are making supplies through e-commerce operators, let us say Amazon or Flipkart. So till now, there was a mechanism of 1% of tax collection at source, which has now been reduced to 0.5%. This would give a big relief to many small and medium and micro suppliers who are supplying through this Amazon and Flipkart, because till now there was 1% deduction of TCS, which will now reduce to 0.5%. Maybe government has realized that eventually what is that they are collecting is going into refunds and refunded back, and that's why there's no point holding. It's a welcome move. It would really benefit this MSME micro industry, I would say. Next is exemption for compensation cess leviable on imports in SEZ. So there is an exemption which is given for IGST. There's a specific notification, CGST and SGST, but I think they missed giving this notification in the context of compensation cess, which they have now rightly issued the notification and given the exemption for even compensation cess when just supplied to this SEZ units. Next. Very important, this anti-profiteering, when it came, it brought chaos. I remember seeing the headlines in the news where, thousands of crores, I think it was around 10,000 crores or 11,000 crores of anti-profiteering demand on these consumer goods companies, HU, Hindustan Unilever, and all your restaurant chains. A lot of builders have faced the wrath of this anti-profiteering. Finally, they are saying we are going to bring a sunset date for anti-profiteering, which means the last application for anti-profiteering can be made by 1st of April 2025, post which the entire system or the provision of anti-profiteering would be dead null. So, and all the past cases of anti-profiteering, which were heard by the Competition Commission of India, are being moved to the principal bench of GST Appellate Tribunal. Principal bench would be in Delhi. So this is also a good move, because what was happening is that the Competition Commission of India was not able to understand the vigors of the taxation, and they were actually confirming the liability. So we hope our past experience of tribunal being fair would give relief to all the huge demands under anti-profiteering that are levied in the past by the authorities to builders and FMCG companies. Next is this B2C supplies to be reported for 1 lakh instead of 2.5 lakhs. So currently what happens, B2C transactions beyond 2.5 lakhs, you only need to give the state-wise information and not at a transaction level. So that they are going to bring down to 1 lakh. Till now, they have not yet notified the date, but this is what they are saying. Let me tell you, with all these amendments coming in, one thing is clear. Whether litigation in GST will remain or not is a different matter, but the compliance in GST is certainly going to be there. What government is doing is that they are treating GST returns as a mechanism of collecting information from the taxpayers, because they are getting a first-hand transaction level information with description of all the invoices at a real-time basis. So for government, this information collection is becoming a very beautiful thing through GST and leading to heavy compliances. The returns day by day GSTR 1, 3B are only getting complicated. In fact, the entire ISD system is introduced only to take care of proper distribution of revenue between all the states and all. And this has to be done. This responsibility is shifted on the taxpayer through ISD instead of settlement at the top level. Now, there is also a saying which is going, currently, this is not in the news as well, is that government is looking for e-invoicing even in the B2C transactions. And this particular move is somewhere towards that. But don't be surprised if e-invoicing also comes in B2C transactions in future. Let me tell you, it will be hell of a compliance for businesses. GSTR 9 is exempted for turnover less than 2 crore. Needless to say, this has been continued. So there was, e-commerce operators. Earlier there was a system that only registered vendor can supply to e-commerce operator. In case of intrastate, which was last year amended, even unregistered vendors were given the flexibility to supply through e-commerce operator with some conditions. So if these conditions are breached, there was a penalty under 122(1)(b). What they have mentioned is that this particular penalty is applicable only to those e-commerce operators who are required to collect the taxes. So if there are e-commerce operators not governed by TCS provisions, then there's no question of this penalty under 122(1)(b), which is what is there. Next is this biometric-based Aadhaar authentication to be rolled out on all India basis for taking registration under GST. So this was implemented in Gujarat on a test check basis. Now it is being rolled out on a pan-India level. I was given to understand that in whatever that was done in Gujarat, it was very cumbersome and complicated, and taking registration was become more complicated than simplification. So not sure what led to this particular thing, but the way we got registration in GST at the beginning of the GST law is now totally changed. Now taking a registration under GST has become very complicated. Even a small difference in the rental agreement, small details not available in the lease agreement. Lease agreement has to be in a particular format. There should be the NOC from the owner. So many things being demanded. Physical verification, which was there in excise, has started. So all the complexities of central excise have actually come back in the process of taking registration. At least the cases that come to us, we find issues in claiming registration by the taxpayers, which was not the case when GST law was implemented. Of course, this has also to do with a lot of fake registrations and fake things that actually ramped up in 2018, 2019, 2020, which made government to rethink the ease of, somebody says in Singapore, you can form a company in one day. That was the case in GST registration. We could have taken GST registration at a click of online in 3 days with no questions asked, but that led to a lot of dummy registrations. Government has gone back to the old system saying we are not Singapore, this is India. We have to verify, and registration will come only upon following a process. Next slide. Next is in case of automobile industry for taxability of warranties. See, we need to understand that when any goods are removed under warranty, there is no further taxability because collected in the original transaction. There is no further supply and the transaction is not liable to GST. This was clarified in the earlier circular, I think circular 195. But then only thing is in that clarification, they have used the term parts. So there was question, what happens if not just parts, the entire goods are given under warranty, then what happens? So they have told, no, don't worry, not just parts, it is even for the entire goods also. But what is important is that many times as consultants or as businesses, we think if it is warranty, it is not liable to tax. But let me tell you, that is not correct always. We need to understand when a particular goods is given for warranty, what happens to the original transaction? Because what happens to the faulty goods? If the faulty goods is returned back under a credit note or under a tax invoice, under a GST credit note, then the earlier original transaction has been nullified which means the original 18 rupees GST paid has been made 0. So the fresh goods which are now going has to be levied to GST, and there will be a taxability in such scenario. Very important to note that the taxability can also come where a manufacturer issues a commercial credit note, because from the recipient angle, when he is removing the faulty goods, the faulty goods are covered under Schedule 1, where there is a permanent transfer or disposal of business assets where ITC has been claimed on such assets. So whenever a assessment is made of the warranty transactions, to say that GST is not applicable in case of goods removed under warranty is not correct. One has to complete the circle and look at the transaction from both angles. That is for the goods that are going under warranty and the goods, the faulty goods, which is getting returned back. Depending upon under what document the faulty goods is coming back, the taxability of the goods going under warranty would be determined. Next, in the context of extended warranty, what they have told is that extended warranty is generally given, with an additional price. That when we are selling, let us say we are selling AC, there is a 3-year warranty that comes built. And if you want extended warranty, we will charge you, 5,000 rupees for the extended warranty. Now, the point is that there was a question whether this extended warranty should be levied to tax based on the tax on the main goods, or it would be leviable to 18% tax. So earlier they told that it would be bundled and it would be taxed based on the taxability of the main goods, but later they have clarified saying that this extended warranty sometimes, what happens is that manufacturer of the AC gives the AC, or sorry, the dealer gives the AC, but the extended warranty is given by the manufacturer. Or sometimes it so happens that the dealer gives the AC and the extended warranty is taken subsequently later, not at the time of sale of the AC. So in these two scenarios, they have told that extended warranty would be taxed separately at 18% and not at the rate of tax as applicable to the goods. But what they have not clarified here, what happens in a scenario where the extended warranty is given along with the sale of the goods. So indirectly what they are saying is that when the extended warranty is given along with the sale of the goods, the extended warranty would be liable to tax at a composite supply at the rate of tax as applicable to the goods at whatever, let's say 28% or whatever the rate. Let me tell you, in my opinion, this particular view is wrong, would not hold good, because a principle of composite supply comes when a transaction is naturally bundled. When the transaction is not bundled in the first place, generally the choice of taking an extended warranty is given to the customer. If a customer chose, only then he will take the extended warranty. If he has not chosen to take extended warranty, when the transaction is unbundled, there is no question of levying taxability of this thing on a composite supply basis. Of course, one need to represent. Probably we would require third circular to clarify on extended guarantee. Next slide. Very important amendment in the context of this hostel, PG, guest house. I don't know whether to call it as a good amendment or bad amendment, because this industry is struggling very badly. What they have told earlier, there was an exemption of 1,000 rupees per day, for this thing. Later they removed it. Now they are saying is made liable to tax. Now what they are saying is that so now what they are saying is this 20,000 up to 20,000 per month would not be taxable, provided the property is given for at least more than 90 days. What do you mean by 90 days? Is it the intent or the actual transaction? Because nobody comes to know at the time of giving the property whether it will be 90 days or 60 days. Let us say one gives it for 1 year, but the customer decides to leave after 60 days, then would that mean that taxability would change? Is something still not clear? In my opinion, it has to be the intent. But very important is that once this exemption comes in, the industry will be in a bigger problem, because the property that they are taking on rent is taxed under reverse charge. So they are having huge taxation. They are paying tax on almost 70 to 80% of their purchases, and the outward is exempt. So their entire business is becoming unviable. And this is what practically we have seen, because this entire business of guest house, PG, co-living is extremely working capital heavy. Every month on month, whether you get full occupancy, 100 occupancy or 50% occupancy, you have to make the payment of rent to the landlord every month. So in my opinion, still lot government needs to do in this industry to really save this industry. ENA is a raw material used in manufacture of alcoholic liquor for human consumption. They are saying that ENA, there was an issue that ENA is as good as alcoholic liquor for human consumption because it is a concentrate. Let me tell you, you cannot drink ENA. If somebody drinks ENA, then person would have complications. He would die immediately. The point is, government has now started extending the benefit of alcoholic liquor for human consumption to the raw material of alcoholic liquor for human consumption. My problem is, how can this benefit be given without first amending the constitution? Because under constitution, ENA is levied to state VAT. In fact, there are many state VAT departments which are levying ENA taxability of on ENAs. So this is a bit of complication happening across the state. Different states are following different practices. Multiple writ petitions have been filed stating that this should be liable to GST. There are writ petitions filed stating it is liable to state VAT. So the problem is, if the government is saying that ENA is not liable to state VAT and liable to GST and giving exemption, excluding under GST, so first an amendment in the constitution is required. Otherwise, this particular amendment is not possible. Then there is a clarification even given for banking services on custodial thing that it is place of supplies outside India. This is a welcome move. Then for this lot of construction contracts, there was an issue as to taxability, because what happened is the construction of road is completed fully, but the assessee was to be paying the government was paying to the assessee over 15 years based on the O&M contracts, operation management contracts. Department was levying demand saying that since the construction of road is completed fully, you pay the entire GST today itself. Which they have rightly clarified that it is not liable. It is liable as and when the installments payable are. Then same benefit would be applicable for any other construction projects, mining projects. There was issue on ITC eligibility on ducts and manuals for telecom sector. They have told it is eligible. Next slide. Then these are some amendments in the insurance sector. I will not go into the detailing of one by one. If somebody is in insurance sector, then basically a lot of reinsurance, co-insurance, where there were multiple demands being raised by the insurance companies. While the policies was raised, it was a big time demand through DGGI. It was happening, a big time industry issue which they have clarified. So I'm not going into the details of this thing. We have still kept it in slides, so if anybody wants to refer, they can refer. This will be sharing the presentation. Next slide. Next slide. Next slide. Yeah. Then what we have done is there are some fitment committee has given some changes in the rates, for example, for aircraft maintenance items and some other items. So we have simply tabulated the various rate changes. This is very industry specific. I'll not be going into the detailing of this particular thing. Azhar, can you change the next slide? Yeah, these are the additional rate changes. Yes. Yeah, next slide, Azhar. Azhar, you can go to the next slide. I think this is the last slide which I had to deliberate upon. Azhar, can you please move to the next slide? Yeah, that was the last slide, basically where, some rate changes we have tabulated it. So what we can now do is we can take up the questions. Sudhir sir, you're also there?
I'm there, Ravi. Hope I'm audible.
Yes, sir, you are audible. So what I would do, there are some questions that have come, I will read out so that we can answer them. There are some questions in the chat box. If there is reversal of ITC under Rule 42 applicable on any company, whether it can be said that full ITC is available to a company as per second proviso to Rule 28 under GST rules. So that's what, Vinayak, even if the Rule 42 thing is there, one has to look at a transaction level whether that invoice is covered under the Rule 42 or not. So we need to look at the substantive aspect of full ITC claim. Sudhir sir, your views on this?
Nothing more to add.
Yeah. Then there is another question. Any taxes paid by order under 17.5 is ineligible credit. How RCM can be claimed?
He has again asked 74. He says if
74.
the amount is paid under 74 under RCM, is it not restricted under 75? How the credit can be claimed?
Correct. So over there, sir, we need to understand that it is what 74 is what department is claiming. Whether it is 74 or not in real is something the conclusion of the dispute would say. Correct. And that is the reason you are disputing this entire thing. Once you have made a voluntary DRC under 73, it means as per you, it is still a case of non-fraud. Just because there is a matter department has written as 74, it cannot be said as a conclusion 74 because that is what you are disputing. Correct, sir? And that is the premise on which we can take the credit.
If you want to
I
take
add
the
something.
credit of RCM, one
Yes,
minute,
sir.
I'll just finish, sir, Madhukar sir. If you want to take the credit under of the RCM, you have to dispute 74 and get the notice noted into 73, which would be most required. Madhukar sir, over to you.
Yeah, what I'm saying is that the way the department has been looking at it, most of the time they sleep over the matter for 2-3 years. And at the end of that 3 years, at the end of the 5th year, where there is no time at all, they want to issue the notice in spite of getting that COVID 2 years, exemption also. So they had no choice. The department had no choice but to put 74 for everything. This is number one. You have to understand that. Everybody should understand that they had no choice. So they, in a routine manner, they added those. But as Ravi said, it has to be proved. And it's very difficult to prove in GST that you are not, you are misrepresenting or you are suppressing information unless you are actually doing a fraud. So if you are not doing a fraud, there is no chance for the department to claim that there is a fraud because of some action not done. Everything is available on the public portal. ROC's office is available. GST network is available. You are filing your returns every time. There is no chance in which the department can say that you have engaged in suppression of information. So if I look at, say, 10,000 cases, if they are making, saying that there is a fraud or suppression, in my understanding, 9,900 of them will simply sail through saying that there is no suppression or fraud. So only the point which has to come here is what Sudhir sir says, we may have to approach the writ court for such a thing. Otherwise, this story of the not inability to take ITC may go on for another few years. So better to approach the writ court wherever possible and get the point that this is a incorrect, invocation of 74 itself. And once there are a few cases in precedence, you should be able to get the credit within the next couple of months. Yeah. Next question.
Yeah, just to also add over there is that in the digital era, we are in the digital era in GST, where transaction level, invoice level details to, if the details were not available from the customer's end itself, whether the increase in debit note, we come to know only from customer after, let's say, 6 months or 1 year, whether still the interest would be leviable in the case of raising of debit note. So as I've told Vinayak, there is a Supreme Court judgment of Steel Authority of India Limited in the case of excise saying that interest would be applicable. But then we need to understand that the excise, the taxability was purely on removal. In GST, it is supply. So, in fact, there's an explanation to section 13, which says that time of supply is deemed to be arise to the extent of the invoice raised. So we can look at differentiating ourselves from the excise regime because a taxable event has changed, and basis this explanation, we need to look at differentiating this aspect because this is a genuine issue, as you have rightly pointed, especially in automobile manufacturing and any other manufacturing. Sudhir sir, you would like to add here?
Yeah, it's unfortunate that they are asking an interest on that because you are not able to determine. But the concept of supply being already made and the consideration for them, additional consideration accrues on a later date. So to that extent, there is going to be a challenge. Yeah, so this is a business problem. Ravi, as Ravi told, some differentiation we could look at from central excise and GST, but we need to see how the courts are going to interpret.
Sudhir, there is a specific question for you. Neeraj.
Yeah. I will look into it. Ravi, you can take the next question of Advait. Extended warranty price.
Yeah. Okay, so B2C, this is not yet clear which date it will come. When we are receiving bills for rent, please communicate to all vendors to account the actual place of business where we have taken rent.
He is asking which is the place of supply.
Place of supply in case of rent is the place where the immovable property is situated. While the location of billing can be from the different location. Let us say the landlord is in Maharashtra and the property is in Delhi. Landlord need not take registration in Delhi. Landlord can raise the invoice from Maharashtra to Delhi, while the place of supply remains to be the place where the property is there, which is Delhi. So location of supplier, that is a billing address, that is a supplier address can be different. There is no problem in that. It's not necessary that the one has to take registration in Delhi and only then raise a invoice. If extended warranty added in the car price list, should we change 18% or 28%? It doesn't matter, sir. Even if it is there in the car price list, generally in any car price list, it would be there. The point is that it is an option, it is a choice. I can choose not to take extended warranty or roadside assistance or the extra. As long as it is an option and a choice to the customer, it cannot be said to be bundled in the first place. Hence, the taxability should be 18% and not the rate at which the original transaction is applicable. Sudhir sir, you have anything to add here?
Perfect.
Yeah. For
Article
transport,
14 will support you there. Because when I go for that particular service or item, say I buy the car and go to somebody else for that, the rate will be the rate of the item or the service. So just because it is there, so you have two reasons, Article 14 and also that it is not bundled in normal course. Option is there. And this is option is a well settled matter in central excise.
yes. For transportation charges, 5%, is it eligible for ITC? No, that is not eligible. Again, it depends whether who it is under the, they are both. Specifically in the logistics business, especially where they are also looking at having the trucks in their assets. In case of bill to ship to transaction, where
one
the
small
third
clarity, Ravi. If I am paying under reverse charge RCM 5%, I am eligible to take the credit.
Yeah, that is eligible.
Transporter
Correct.
is charging 5%. He is not eligible to take the credit, but that 5% I am eligible as a recipient. Just so that people will not confuse.
Correct. Correct. So next is in case of bill to ship to transaction where the third party is unregistered person, whether section 10(1)B will apply or 10(1)CA as per, see they have clarified as per the recent circular, it will be 10(1)CA that would be applied, not 10(1)B. That is also clarified in the circular. So whatever is the delivery address actually that you will give, that would be the place of supply. So which is also coming in the clarification. Is there any update on mismatch of ITC claimed in 2A, 3B for 17, 18, 18? I think this will take care of all your, that amnesty benefit which Sudhir sir has explained. Those under that you can claim this benefit for any litigation, be it mismatch or any other matter for that case. Next is, sir, ITC is not claimed for 17, 18, also not disclosed 99C. However, it is reflected in 2A. All these 3 years ITC claimed 2021. Whether yes, so this relaxation is actually applicable for this scenario. If you have claimed in 2021, it is as good as complied since the time limit is extended retrospectively. So I think you can claim that benefit. That's what is there. We need to, of course, wait for the actual
very
text.
Important that it has to be claimed in 3B before the 21. November 21 or September 21.
Yeah, I think Mr. Neeraj has told that he has missed out on something. So maybe,
Yeah. Will be disposed based on 128A is what I am looking at. It makes more easy procedurally, but we need to wait for the clarity.
Correct. And then there is a question from Mr. Pinal Shah. Can taxpayer ask for refund of tax paid along with interest for that in respect of expat salaries and brand logo before issuance of circular 122? See, firstly, we need to understand that circular is only clarification in nature. Circular is not creating a new law or changing any law. So what is the taxability before circular, after circular doesn't make a difference. In case of expat salaries, there is a judgment in case of Northern Operating saying that it is liable to tax. Later, department has issued a release saying that that particular judgment is applicable only on the facts of that particular case. So there is an important point that once a transaction is that of an employer and employee, it cannot be levy of either service tax or GST on that transaction. So at claiming the refund as per the provisions of refund. One cannot look at circular 210 in a scenario where the consideration is charged, because once the consideration is charged, that consideration as per rule 28 would be deemed to be the open market value. So circular 210 would be applicable in a scenario where no consideration is charged. Then the value should be treated as nil, provided the recipient is eligible for full ITC. But when the specific consideration is charged for this expat, in my opinion, that circular should not be applied basis rule 28 of the CGST rules. Your circular is ultimately trying to interpret rule 28, the proviso to rule 28. Can you elaborate on the interpretation of full ITC available? So I've already explained that. What I'm trying to say is that, let us say if there is a minor reversal of ITC because of some securities transactions or some minor head office ineligible credits, leading to reversal of ITC on some common transactions. So if first of all, if the transaction itself is not in the common bucket, it is in the full ITC eligible bucket, there is anyway no question of reversal because at transaction. But let us say it goes into the common and there is some minor reversal of ITC coming in because of let us say some exempt transaction in the HO or some financial transaction. In our opinion, one need to look at a dominant intention and the dominant nature of the transaction. This minuscule reversal cannot be said that the full ITC is not eligible. Full ITC is available in this case with a reversal for a minuscule amount. So one has to read the law with a, I would say, purposeful interpretation rather than too literal interpretation in this particular case.
There is a legal. In which case you need not take the law to that extent to say, oh, in this case you have done this. So,
I think that maxim is casus omissus, something, there's a legal word to it, yes.
it talks about that case, I remember, it talks that triviality, law is not for trivialities.
Correct. So I think we have answered all the questions that are there. There are still a lot of questions coming in, but we have exceeded the time. So the presentation would be shared with everybody, and the email IDs of the speakers is also available in the presentation. So
Ravi, you
thank
can
everyone.
answer the queries to when you send this. You can also answer the queries which I have missed. If you have missed any query, cover it when you are sending. In that email, it may take 1 page, 5 questions maybe.
I think
thankful for everybody.
Sir, Khushbu Agarwal has actually given that Latin maxim, which you rightly said, de minimis. This is called as de minimis principle.
Correct.
Correct, which is very rightly brought in. Thank you, Khushbu.
Yeah. This is all 20, 25 years old back knowledge for me. I don't go to the court also. Thanks a lot for everybody joining and, sharpening us also. Thank you very much.
Thank you, everyone, for the patient listening. Thank you all.
Thank you, Madhukar sir. Thank you, Ravi sir, and thank you, Sudhir sir, for conducting such a knowledgeable seminar.